how they're going to communicate to the markets that the Fed reaction function, now that interest rates are getting to 4%, is going to be different from when they first started increasing interest rates by 75 basis points at each meeting. So I think the key for Powell here will be, okay, we're going to continue to increase interest rates going forward, but at a slower pace. However, I think the slowing down of the pace of interest rate increases is not the same as a pause. And so I think this will be the message that they want to bring in to balance this tightening of financial conditions that they need to keep as their baseline.
So what are the implications for the market if the Fed changes its tone, if it pivots?
I think the markets will see this as a sign of relief. There's going to be an initial relief that, okay, the Fed is not intent of doing this breakneck speed of tightening going forward. However, I think what is very important to remember is that once we get to the point in time when the Fed slows down the pace of hiking or pauses, that's not the end. I think this business cycle is going to look quite different from the other cycles, where I don't think cutting interest rates will come just as quickly as it's been the case before, just because where inflation is.
Is there a risk that the pivot might come too early and the Fed undoes what it's achieved so far?
I think there is a chance to that also because the data have not been corroborating so far. And I think the Fed has tied itself a lot to realized inflation because their staff and FOMC members themselves got the forecast so wrong last year about transitory inflation. So there could be a case where the consumer, the US consumer, holds out better than expected, and it allows firms to continue passing on those higher wage costs and input costs into prices. But I don't think this should be our baseline scenario or the higher probability scenario.
Blerina, how are consumers and businesses going with higher inflation and rates in the US?
So this is a very interesting question because we're always talking about monetary policy being transmitted with long and variable lags. But I think we just need to look at the more interest rate sensitive sectors of the economy, and that's the housing market. The housing market is going through a very dramatic adjustment right now. Sales starts have all dropped significantly. Residential investment is pretty low. So I think this is telling us that the effect of higher interest rates is being felt in the economy, and it's just going to take a little bit longer before it spreads elsewhere.
Well, we know, Blerina, there are a number of structural and supply-side factors keeping inflation higher. What are they? And can the Fed really get on top of inflation? Can it be tamed?
This is a great question and puzzle for the Fed, because if we're thinking about how can the Fed bring inflation down, we need to understand the sources of it. And there is a very complex mix going on at the moment. We have some supply side dynamics. At a time when demand for goods was strong, we didn't have the resources to produce them because of supply chain issues, because lack of parts. And so the supply side of the economy could not expand fast enough to keep up with demand. We also have some labor shortages here in the US because of demographics. That's been a long ongoing trend, but we also had a collapse in immigration flows and migrant workers since the start of the pandemic. So those are typically the sort of factors the Fed cannot affect. The Fed can affect demand, so consumer spending, demand for workers. And I think because inflation is so high, they're going to have to lean that much harder into these demand factors that they can affect. And because interest rates are such a blunt tool, they might end up over tightening in order to bring inflation down.
And finally, how's the strength of the US dollar playing into the decision-making for the Fed and ultimately the longer-term outlook for the US economy?
I think as far as the Fed is concerned, a stronger dollar is helping a little bit on the margin with the inflation story. It's going to help to bring down goods inflation in the US. But also I think they have to consider the broader implications for companies that export. Down the line, it's also going to dampen growth in the US, which they're also trying to achieve with higher interest rates. But more importantly, I think we also need to consider the financial stability risks for countries that have debt denominated in the dollars for commodity exporters. It's a complex story. I think the Fed looks at it with respect and takes it as a given with respect to the implications for the US economy.
Blerina Uruci, thank you.
Thank you for having me.